Welcome to Skilled MBA Case Study Series in Accounting. The HUL&GSK merger in April 2020 led to a significant increase in intangible assets. This surge was due to the valuation of brand equity, customer relationships, and intellectual property. These non-physical assets became crucial in enhancing market presence and competitive advantage, reflecting the strategic importance of intangibles in modern business landscapes. The merger allowed Hindustan Unilever Limited to penetrate the health food drinks market with Horlicks and Boost, enhancing market expansion. It wasn't merely about products, it was a strategic diversification move. Additionally, Hindustan Unilever Limited gained control over robust distribution networks, particularly in Tier 2 and 3 cities, strengthening their supply chain management. The merger, valued at R31,700 crores, highlighted a significant focus on intangible assets, comprising over 69% of the total deal value. This allocation raised concerns among investors and analysts, questioning the strategic rationale and future financial implications of such a heavy emphasis on non-physical assets. Before the merger, GSK's books lacked visibility of many intangible assets. The acquisition process highlighted substantial non-physical asset value. Post-merger, HUL's balance sheet showed a significant increase in goodwill and brand value, reflecting these previously unrecognized assets. Internally developed brands, as per Indian Accounting Standards 38, aren't recognized as assets on balance sheets. This explains why GlaxoSmithKline's books didn't reflect these intangibles. Only through acquisition can such assets be valued and recorded, revealing their true worth. Heritage brands like Horlicks and Boost hold immense brand value, trusted for decades in Indian households. Their strong distribution networks, especially in Tier 2 and 3 cities, bolster their market presence. With an established customer base and significant market share in health drinks, exclusive licensing and rights further enhance their competitive edge. Horlicks' value stems from its 93-year legacy in India, establishing it as a market leader with over 50% share. Its high consumer trust index and premium positioning enable significant price power, reinforcing its brand strength. Goodwill is the premium over the fair value of net identifiable assets, reflecting expected future economic benefits. Despite negative perceptions, it signifies potential synergies, as seen in the Hindustan Unilever Limited GlaxoSmithKline merger, with goodwill of Rs 4,700 crores. Regular impairment testing ensures its validity, crucial for maintaining accurate financial statements. Health food drinks are outpacing traditional fast-moving consumer goods growth, reflecting a strategic market shift. Hindustan Unilever Limited's acquisition aligns with this consumer trend towards health and wellness, a move accelerated post-pandemic. This validates the strategic decision, highlighting the importance of adapting to evolving consumer preferences in the fast-moving consumer goods sector. Cultural alignment is crucial in mergers, ensuring employee morale and productivity remain high. Supply chain integration must be seamless to avoid disruptions in manufacturing and distribution. Managing the brand portfolio involves preventing cannibalization while maximizing cross-selling. Finally, there's pressure to demonstrate return on investment, justifying the premium paid for intangible assets. The future outlook for this merger includes a stronger portfolio in the wellness sector, enhanced distribution networks, and cross-selling opportunities. However, challenges like sustaining brand relevance, new market entrants, and changing consumer preferences persist. Success depends on leveraging intangible assets through innovation and marketing to justify the premium valuation. The Kraft Heinz merger allocated 75% of its $19 billion value to intangibles, later facing goodwill impairment. Tata's $3.2 billion acquisition of Tetley saw brand value as 65% of the purchase price, showcasing successful intangible asset leverage. Godrej's $4.9 billion acquisition of Darling Group highlighted regional expansion, with distribution networks as key intangible value. Mergers and acquisitions deals often uncover hidden value beyond physical assets. Goodwill, representing future benefits and synergies, isn't inherently negative. Strategic alignment should justify financial risks and premiums for intangibles. Skilled managers interpret financial statements to understand the true narrative behind the numbers, balancing strategy with financial insights. In mergers and acquisitions, strategic insight beyond numbers defines leadership. The HUL&GSK merger shows how accounting impacts intangible asset values. True value emerges as synergies develop over time. Thank You and Skilled MBA dissects real-world mergers and acquisitions to provide strategic insights. Our case studies enhance your understanding of complex business dynamics. Subscribe for in-depth analyses that refine your strategic acumen.